All right. Can everyone see my screen?
Yep.
Okay, so let's go ahead and get started. We're going to talk today about some recommendations that came out of the September 9th G20 summit in New Delhi. Primarily what we're going to talk about is cryptocurrency and stable coins and kind of impact on financial systems. But I think the other kind of major topics, just for everyone's background, was the G20 focused on global cooperation on food security and energy. They agreed to climate change and sustainable development, focus on global health, and then as it relates to kind of cryptocurrency and stable coins, they also focused on digital transformation. So those are kind of the leading four takeaways. The G20 leaders recognize the importance of digital transformation in driving economic growth and development. They committed to working together to promote digital inclusion while addressing challenges associated with digital technologies such as cybersecurity, data privacy, stablecoins, and crypto. So with that, we'll get into it. Again, from an overview standpoint, what we saw come out of the G20 was they endorsed a set of recommendations that were previously proposed by the Financial Stability Board and the International Monetary Fund for the regulation of cryptocurrency and stablecoins. Recommendations were designed to promote responsible innovation, protect consumers and investors while mitigating financial stability risk. I'll send everyone a copy of the presentation, but in the appendix, I've got kind of the details of the FSB and IMF recommendations. But as it relates to the FSB, they recommended that stablecoins be subject to regulation that is consistent with their systematic importance. That's pretty critical because the rest of the world has moved very far along with adoption of stable coins and actually working their way into traditional finance. The U.S. has been waiting on kind of Congress to provide some regulatory guidance. But that said, we are seeing quite a bit of movement here in the States, and I'll talk about that in a bit. FSB also suggested that regulators should cooperate internationally to ensure that stablecoins are subject to consistent regulation. Regulators should ensure that stablecoins are backed by assets that are liquid and can easily be converted to cash. For anyone that remembers the Terra Luna debacle from about 2 years ago, was a quote stablecoin. It was an algorithmic stablecoin that was not backed by anything. Most stablecoins that exist today, certainly the more popular ones, are backed by physical assets that are liquid. Most of them tend to be cash and or short-term treasuries. Regulators should require stablecoin issuers to have adequate risk management systems in place, and regulators should require stablecoin issuers to be transparent about their operation. Now, just talked about stablecoin. I want to differentiate between stablecoins and tokenized deposits, mostly because regulators outside of, regulators in the U.S., some regulators outside the U.S. are starting to differentiate between the two, but in the U.S., most regulators could not tell you the difference between a stablecoin and a tokenized deposit, but there are very important differences. And out of all of the digital asset stuff that has happened over the past however many years, I'm starting to come to the realization that it's not going to be, the disruptors aren't going to be the Bitcoins of the world, or maybe even the Ethereums or DeFi, but are going to be adoption of stable coins and or tokenized deposits. And best way to think about these things are digital tokens of physical dollars. And so you may be thinking, well, why would we need a digital token of physical dollars? The reason being is, think about how banking works today. We've got every bank and every credit union has its own books, their own set of ledgers. And anytime that money is moved, it's mostly moved electronically, and it's actually not moved. It's just that two institutions will update nearly simultaneously, or not necessarily simultaneously, the debits and credits on their ledgers to reflect the quote money movement. And the problem with that is because it isn't always simultaneously, and because it does require a fair degree of kind of double checking and reconciliation. That's a slow process and it's an expensive process. Some of you may have sat in on my earlier talk back a couple of weeks ago, which was an overview of the Bank for International Settlements blueprint on the future monetary system. And in that, they outlined a world where finance moves to a unified ledger, so kind of a shared ledger. And the reason for that is when you've got institutions sharing a shared ledger, you don't have to do that reconciliation. Any movement or data entries in that ledger are instantaneous. There's no more any settlement risk. There's no counterparty risk. It solves a whole bunch of problems like that. It is instantaneous. And it's very inexpensive, and it doesn't require lots and lots of third parties. So think about like an international transaction today, maybe sending money from somewhere here in the US to somewhere over in France. It's going to require a correspondent banking relationship. It's going to require a bunch of data ledger entries, possible mistakes, checks for know your customer AML type checks, and it's going to take a long time and probably cost somewhere between $25 to $75. That can be done on a unified ledger using either stablecoins or tokenized deposits nearly instantly for no cost or very little cost at all. So there's an opportunity for efficiency, for financial institutions to save money, for financial institutions to eliminate counterparty risk and settlement risk. And also because it is cheaper to run those transactions and not use various intermediaries, a bank and credit union could charge their own rate for that transaction. So there is a revenue opportunity. So let me describe real quickly the difference between stablecoins and tokenized deposits. Stablecoins are privately issued. So when I say privately issued, some examples would be Tether is a private company, it's an international company that issues stablecoins. Circle is a US company that issues a stablecoin called USDC. PayPal recently issued their own stablecoin called PYUSD. Those are privately issued. Those are not bank issued. Those are not Fed issued. Those are privately issued. And they allow for the direct payment between businesses, individuals, merchants, and others over public permissionless blockchains. Another way of saying that is public permissionless ledgers. So again, a shared ledger that everyone in theory can see, anyone can have access to it. And those transactions are completed completely outside the existing payment rails. For those stable coins to work properly and internationally, these kind of requirements in the US, this will ultimately be a requirement when we get this instituted into law. Stable coins would be required to be fully collateralized. That is not the same as deposits today or tokenized deposits for anyone that's familiar with kind of the idea of fractional reserve banking. But in the case of stable coins, fully collateralized would be the equivalent of full reserve banking, which is really another way of saying narrow banking. And it's something that got popular usually after financial crises, but the idea of a bank that kind of takes a narrow approach, also called a safe bank. And what they typically do is deposit taking. They don't do any lending against those deposits. They don't create any liabilities by doing so. And payment activities are separated from financial intermediary activities. The Federal Reserve, interestingly enough, has not actually approved any full reserve banks to exist for a whole host of reasons, including it can tie up liquidity. But at any rate, stable coins are about the closest thing we get to full reserve banking. Now those dollars that back a stable coin, they still sit somewhere, and they sit typically in a federally reserved institution. So the example of Circle earlier, Circle is one of the more popular stable coins. I think it's got about 50 billion in market cap. It's responsible for probably $1 trillion of transactions annually, and is growing in in acceptance. So those Circle was backed by US dollars. Most of their dollars in short-term treasuries were sitting in a Chase account, but some at the beginning of the year were sitting in a bank out in California called Silicon Valley, along with a bunch of other VC type money. And it turned out $2 billion was sitting out there. So when Silicon Valley failed, it actually impacted that particular stablecoin, and that there was question of whether or not that $2 billion would be available as fully backing reserve, and Circle temporarily lost its peg. Anyway, so stable coins have some pluses and minuses. Tokenized deposits, on the other hand, which are a lot like stable coins, are depository institution issued, so bank and credit union issued. These would allow, again, just like stable coins, direct payment between businesses, individuals, merchants, and others over, again, a ledger, but instead of it being a public permissionless, it's a private permissioned blockchain or ledger. And again, outside the existing payment rails. Tokenized deposits may or may not be fully collateralized. So for an example, if you create a deposit token that is a digital representation of real deposits, well, we in banking lend against those deposits. So there's liabilities. And if anyone is familiar with fractional reserve banking, a bank only has to hold a fair amount, a small amount of deposits relative to what they lend back out. That's essentially how banks create money, or private money, is by lending against some amount of deposits. Those deposits, because they're not fully backed, or those loans, because they're not fully backed by deposits, banks have deposit insurance, credit unions have share insurance to protect the fact that they're not fully backed and to prevent, say, runs on the banks. Some recent examples of tokenized deposits, and there's a lot of banks looking at this right now. There's a consortium called USDF Consortium. The CEO, Rob Morgan, was featured on one of our tech talks a few weeks back. There's a company called Tacit. We've talked with them as well on our old Crypto University. JPM, or JP Morgan, has a coin, a tokenized deposit coin. Citi recently announced tokenized services. So again, big difference here is tokenized deposits are issued by a bank. Stablecoins are issued by a private institution. In both cases, they're backed by deposits sitting in a financial institution. In the case of stablecoins, they're fully reserved. In the case of tokenized deposits, they're not likely fully reserved. So you don't have the same issue with tying up liquidity. Now, I'm going to pause there and see if there are questions between what's the difference between stablecoins and tokenized deposits. And then we'll talk a little bit some more about the G20 recommendations and what might be the implications for traditional finance, and how in the US we are kind of approaching stablecoins. Any questions? Can everyone still hear me?
Gotcha.
Okay. All right. Let me move to the G20 recommendations. I already gave you a little bit of insight into this. And these recommendations apply to cryptocurrency and stablecoins. Mostly, a lot of this is going to be to stablecoins, but what they're looking for is additional licensing and oversight. Stablecoin issuers should be subject to licensing and oversight by the relative authorities. They're looking for transparency and disclosure. Issuers should be required to disclose comprehensive information about their reserves and operations. Redemption rights, so users should have clear enforceable redemption rights, usually redeemable upon demand within a short period of time, usually less than 24 hours. Proper anti-money laundering, counter-terrorist financing controls should be subject to AML, CFT regulations, and then consumer investor protection. This is important because the U.S. obviously is part of the G20. The U.S. is probably the last one that's implemented anything guidance-wise around stablecoins, even though the White House came out about 2 years ago and requested Congress to provide recommendations. There's been lots of talks in Congress about stablecoins. We've even seen a bill advance past the House Financial Service Committee, but we've not yet seen anything approved. My bet is a number of things are going to push stablecoin legislation through the House and ultimately the Senate, and that's going to change. And it's going to have an impact to the banks and credit unions that we serve and potentially our business to some degree. But it won't be instant. So, all right. So the important thing here is that the industry is not waiting for global regulations. Most companies aren't waiting for stablecoin legislation to occur because, and this is important, everyone knows what the legislation will entail. In fact, Patty and I helped put together some guidance for the NCUA, and some of that I think made its way into different bills or bill recommendations. And really it's, fully reserved backing, fully redeemable in timely manner, regular audits and transparency, the proper know your customer AML, BSA rules. And again, if you look outside the US, plenty of countries have already adopted this. So there is no doubt what stablecoin legislation will look like. The problem in the US, why we haven't seen anything work its way to actually becoming law, is one, because we got divided Congress, but more likely it's because it's come down to an issue of state rights versus federal rights. And there are number of states, including New York, that have very specific stablecoin rules, whereas the federal may have something very different. And so it's becoming an argument about states versus federal rights. Ultimately, this will get solved, but that's why Congress has been so slow. I mentioned earlier that PayPal launched a stablecoin, so you can check the news on that. Circle also announced a partnership with Visa to bring stablecoins to businesses. In that case, it was for Visa partnerships with, say, large merchants that had relationships with crypto companies that wanted to settle with stablecoins. So they adopted that and allow those type of transactions to occur. Citi, within the last week, launched what they call their token services, which is a tokenized deposit for trade finance and cash management. There's a link there you can follow on that. Several blockchains, and really importantly, because I think this is going to gain some traction, there's something called a regulated liability network. I've had some conversations with people at the Fed about this. Regulated Liability Network, or RLN, made a really big splash in the US earlier this year with trials involving several banks. MasterCard was involved in that. The New York Federal Reserve was involved in that as well. There's also a UK regulated liability network that plans to experiment with a retail digital pound backed by commercial bank money or tokenized deposits. Basically, an RLN is a blockchain network for interbank payments and other sort of digital assets. There is, just advanced it. There are, again, being tested by some of the largest banks. There are 3 platforms that are emerging in terms of, blockchains or regulated liability networks. These are Hyperledger, which I believe is an IBM product. Some of these have kind of blended together, R2 and a company called Digital Asset. The messaging that occurs today, particularly on an international basis, so you think about like SWIFT and how that works, that messaging would still continue via the existing ISO 20022 standards, 222 standard. Let's see, what else do I want to cover here? So, once we do see a bill passed in Congress, we might actually start to see merchants accept these tokenized dollars. And again, it could be tokenized deposits or tokenized stable coins, because basically they can ensure by law that these tokens are fully reserved and redeemable. So you wonder, if anyone's wondering why this hasn't happened yet, it's largely because there isn't any legal protections for them to ensure that the stablecoin they accept while, say, Circle says it's fully reserved and can be redeemable upon request, there's no law that says it has to be. And so that's what merchants have been waiting for. Again, I expect we're going to get those laws and we're going to start to see merchants accept that. It could certainly lower transaction processing costs. As an example, I mentioned PayPal stablecoin that can be used to pay merchants or send customer funds. In fact, what I expect we're going to see a lot of is closed loop systems. So some of you may be familiar with ChaseNet, which was a way of Chase settling transactions because Chase had both merchant relationships and customer relationships and deposits. They could settle outside of Visa and MasterCard. So they've experimented with that. PayPal's launch of their stablecoin allows them to settle outside of MasterCard and Visa because it's a closed loop system. So PayPal has both merchant relationships and they have customer relationships. And so their settlement mechanism just happens to be stablecoin, which, from a cost standpoint, instead of costing 200 to 300 basis points are like 5 to 10 basis points. And so it's pretty impactful. And in fact, any institution that has both kind of merchant relationships and customer relationships and banking relationships. So think about like Apple Pay, they could do the exact same thing as well. And I fully anticipate to start to see closed loop systems initially leveraging stable coins, ultimately allowing, kind of inter-blockchain or inter-ledger communication or transfer of funds, which would open up to those closed loop systems becoming open, in which case Visa and MasterCard are going to start to get some real competition. And again, it won't happen overnight, but I do think that over time, for existing payment providers, it's going to feel like a death by a thousand paper cuts. And again, kind of going back to the example of why we haven't seen more competition for Visa and MasterCard is it's difficult to come up with your own network and have all the banking relationships and all the merchant relationships. I mean, it can be done. Discover is its own network. American Express is its own network. Those transact on traditional databases, and those require lots of touch points. So like in a Visa debit credit transaction or MasterCard, there's usually like 7 touch points and intermediaries, and you got the merchant bank and the issuing bank and MasterCard and Visa and the payment processor and various data that's being passed. That is fairly inefficient. It works really well today, but there are now technological solutions that are much cheaper, much more efficient, and we're starting to see adoption internationally, and we'll start to see adoption in the US. Not necessarily related to the G20, but what will be an enabling factor is in 2024, 2025, we are going to get the implementation of open banking standards in the US, meaning that banks will have to open their APIs to fintechs to provide customer banking information to fintechs, assuming that the customer approves it, and vice versa. So we are going to start to see additional competition to the banks and credit unions from the fintechs. And one thing we know about fintechs is that they tend to be less heavily regulated. They also tend to be faster adopters of technology. So unless we see banks and credit unions start to catch up from a technology standpoint, I think they're going to be at a disadvantage in the future. From a conclusion standpoint, the G20 recommendations on crypto and stablecoin represent a significant step towards the development of a global regulatory framework for these assets. These recommendations are important because they provide a clear framework for countries to regulate cryptocurrencies and stablecoins. That definitely is leading to adoption. Again, I think stablecoin and tokenized deposits are probably where it's at, not so much cryptocurrencies, but nevertheless, depending on what country you're in, depending on what payment systems you have, this stuff is going to become, the future. The recommendations certainly will help promote responsible innovation in the sector and protect consumer investors. Again, similar guidance has come from the IMF, World Bank, and the BIS. Alignment and acceptance is occurring. Again, mentioned U.S. has been slow providing regulatory direction by Congress, largely being driven by arguments over federal and state rights. That will clear up, and that will certainly clear up after, I would imagine, after the next election. And we are going to get forced into, or Congress is going to get forced into having to come up with some laws on that, because You consider all the different recent industry actions where banks are no longer waiting for the laws to come from Congress. In addition to that, some of you may remember the Fed, the FDIC, and OCC issued a number of letters to the banks, kind of warning them against cryptocurrency and blockchain and implementations and those sorts of things. Well, I think last month they finally realized that was probably a mistake, and they came out with a novel supervision program, or novel activity supervision program. So if you want, as a bank or a credit, or as a bank, to do something with digital assets or do something with blockchain or digital ledgers or regulated liability networks, you can certainly do that. There still is a requirement to get a non-objection letter. I would presume that Chase recently got a non-objection letter. JP Morgan probably already had one from the Fed, but we will start to see banks get back into this space now that they do have that novel regulatory group. And then let's see. So I wanted to say, yeah, so the G20 agreement, international adoption, will push Congress to action. Once Congress passes those laws regarding stablecoin tokenized deposit issuance, expect, and this is something that just having PayPal issue stablecoin, we're going to see a lot of private issuance, and we're going to see a lot of banks issuing deposits, tokenized deposits. So this is really going to shake up the existing kind of intermediaries, whether that be the international money transfer agents, whether that be retail payments, whether that be P2P solution providers. That is going to get shaken up quite a bit. Expect possible industry adoption, so bank, credit union, fintech, retail adoption. In fact, I know a number of stablecoin projects and tokenized deposit projects that are being worked on literally like right now. And then I mentioned before, in 2024, the open banking requirements of Dodd-Frank Act will require fintechs to provide access to traditional or allow fintechs to get access to traditional finances client data. And that's just going to further accelerate the tools and rails used to move money, make payments, and the impact of associated revenue streams. So with that, I'm going to stop and let's have the conversation about it, see if people have questions. Again, I will share this with the group afterwards. In appendix, I do have the FSB board recommendations. I do have the IMF digital asset recommendations, but let's open up for questions.
Larry, you mentioned the regulations and bills that have to be introduced for this to happen. I mean, do you have any insight into if there are lobbyists promoting the regulations to be put into bills currently, or is that next year, or timing?
So there have been a couple bills that have been proposed. Again, recently one made it out of the House Financial Service Committee. I don't know that will ultimately, still has to get voted on by the House, and then it has to get voted on by the Senate. I don't know that it will happen. It's not likely going to happen this year. There are lobbyists that are pushing this for the digital asset industry. There are also lobbyists pushing kind of traditional incumbents to kind of hold their place in this position. One thing to consider that I didn't really talk about, but it's a bigger picture item, and that bigger picture item is and this is a Federal Reserve issue and a Treasury issue, is where the U.S. dollar, or how the U.S. dollar maintains its reserve currency status around the world. So, most people probably realize that U.S. dollars and treasuries are held by central banks all around the world for a whole host of reasons. That's good for our government, allows us to fund our activities, helps the balance of trade and all of that good stuff. The problem is that there are other countries that would love to have, their central bank currencies take that pole position. And in fact, that has changed over history. British pound had that position for a while. I think India back in like the 1800s had that position for a while. So it's not guaranteed to stay. But one thing to consider, if you went back 20 years ago, 80% of the central banks around the world, 80% of those reserves were held in US dollar denominated, assets. And that is now down to less than 50%. And the US and the G20, or even actually G7, used to make up a huge percent of GDP, whereas, say, other competing country organizations like BRICS generally were fairly small. BRICS recently introduced adopted 6 new countries, Brazil being one of them, which is not a small backward country by any means. And BRICS now represents about 50% of the GDP. So between BRICS and the G20, G7, you've got about 50% on both sides. Fortunately, as international transactions go, all but about 2% are made in US dollars. But that is changing. A lot of countries are reconsidering using US dollars as a reserve currency for transaction, primarily because of what happened with Russia and Ukraine and how we kind of shut down. I mean, we literally seized funds and shut down Russia's ability to transact on a world stage. China took a hard look at that and said, we don't want that to happen. Iran, and then frankly, a lot of friendly countries did as well. So that's an issue. We've seen U.S. Treasury demand from countries fall. Now that has been picked up by institutional demand, but that is a major concern to Treasury and to the Fed and to our government. One shining, opportunity in that is that a lot of countries, while their central banks may be dumping treasuries in US dollars, their citizens are not. And so citizens normally would not have opportunity to hold US dollars, or they would only through the black market. Enter in stable coins in an electronic way for them to hold US dollars as a digital token. We have seen mass adoption around the world of private citizens, particularly in countries with lousy monetary regimes where they've got high inflation rates, store their wealth in digitized US dollars by stablecoins. So because we aren't ready yet for a central bank digital currency, and probably won't ever implement one in the US because of privacy concerns and a whole bunch of other reasons, it's almost guaranteed that the US has to adopt either stablecoins or tokenized deposits as a solution, just to ensure the US dollar maintains its reserve currency status. When that happens, it opens it up for, because of the type of instruments that these digital transactions are, anyone can use them for settlement, including retailers. So it really changes the shape of the existing networks that are out there in terms of, their dominance over the vast majority of consumer transactions.
Yeah, and I guess my point I was getting at, the steer the massive ship we have as our U.S. government changes. It's like, what are the steps, and like when it could realistically impact? And it's not a question of if, it's a when. But in that when, the when could be earliest maybe 3 years, and then latest, 5 years plus. But
I think we see stablecoin legislation next year. Matter of the fact that the industry was pretty sure they were going to see it this year. Another thing to think about the when is, we've got, I think, about $1 trillion in U.S. servicing debt that is about to reprice in, I think, the next 6 to 9 months, treasuries. And that's going to cause, that's going to cause a lot of people to kind of rethink holding U.S. debt. Our servicing costs are going to go up. Again, I think Treasury is going to have to look for, if we can't get other countries to fund our expenditures, then they've got to push for other countries' citizens to fund our expenditures, which means that they will push for, again, that stablecoin adoption. And stablecoin adoption is probably more likely and more likely to impact retail transactions than tokenized deposits, because being there are an open permission blockchain means that they can work on an international basis, which means that people internationally can hold those things, as opposed to tokenized deposits that would be on a permission blockchain, which are basically closed loop systems, would not work well on an international basis. So again, I think a lot of these things that will drive this are geopolitical in nature. Again, how quickly it happens, hard to tell. What I can say definitively is, you can read the articles, is that most of the big banks are working on adoption of some version of a tokenized deposit, looking at stable coins, understanding or considering registered liability network. And the building of those things over the next 2 years is probably where a huge amount of money and opportunity is going to be. We've already seen one credit union group work on launching a credit union stablecoin backed by credit union deposits. I know of at least another company that is working on a similar sort of thing for credit unions. In the banking space, there's at least 3 or 4 big players. And again, they're doing major tests with the US government, Federal Reserve, to make sure these things are ready for prime time. So again, adoption takes a while, but when these things get turned on, it's going to be impactful. Now, I think a good question would be, how's this any different than FedNow? Won't FedNow eliminate some of the need for a tokenized deposit or a stable coin? And I think the answer would be yes, maybe tokenized deposits. Stable coins, no, because FedNow is domestic, just like a tokenized deposit would be. But again, if banks can still do it as cheap as the Fed and maybe make some money on it, again, do a closed loop system, there's probably a way, there's probably some implementation that would, desires that would drive that above FedNow. But I think FedNow is going to will at least hold off on some of the tokenized deposit stuff. But in terms of stable coins, that's something that's going to move ahead pretty quickly. Just my opinion, of course. Other questions? That was a good question, Patrick.
Hey, Larry, it's Dean. So with your example earlier about Circle and them holding money at Silicon Valley and then Silicon Valley failing, that means the stable coins weren't guaranteed, right? Or at least if I was a holder of one of those stable coins, I actually held a risk-based asset that I didn't know was a risk-based asset.
Right.
Generally, if I'm holding a risk-based asset, I'm getting interest on it. Any conversations about how that's working out, or is that just you think that's just like a one-off anomaly that I don't know? It seemed to me it was in it. I don't know, the industry conundrum.
It's not a one-off. It's not a one-off for sure. It was a function of Circle not being a bank. A number of the stablecoin issuers are looking to get, access to the Fed window, which would then allow them to hold those deposits somewhere secure backed by the Fed instead of at a bank where those things are being fractionally lent back out. And obviously, from a reserve standpoint, insurance covers $250,000 now. I find it interesting, and I think, I don't think the FDIC would say this, but while they were bailed out a bunch of Silicon Valley folks that had very big balances above $250,000, I think the big bogey in there was the $2 billion deposits that Circle had, and I think they realized that could have a systematic impact to the financial system if they didn't bail that out, and Circle lost its peg for anything than the temporary, half a day that it did, could really impact not just the crypto markets, but those fledgling industries that are starting to leverage stable coins for other transactions. So I think they were worried about contagion. They said, let's bail this out. If, the Fed gives access to, to the Fed deposits or Fed window or whatever to, stablecoin companies or something along those lines, then I think that eliminates some of that risk of those things being not fully collateralized. That said, there is a concern that stable coins, because they're actually more stable than deposits, could be, and this goes for even a central bank digital currency, is that in times of financial strife, we could see run on the banks to the safety of stable coins or the safety of a central bank digital currency. Because if Congress comes out and says central bank digital currency have to be held fully reserved, those reserves can't be rehypothecated, and they're held at 100%, am I in a risk-on environment going to hold my dollars in deposits that may be covered by $250,000 of deposit insurance or not? Or would I rather just hold stable coins that by law required have 100% backing and aren't rehypothecated out? Any other questions before we close things out? If not, I will send out the deck, and then we'll post the recording for people who may have missed it, and then ultimately we'll provide this as a supplement to our tech talks as well.